Good day, ladies and gentlemen. Welcome to Galaxy Surfactants Ltd. Q4 and FY22 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Unnatan Shekhar, Promoter and Managing Director of Galaxy Surfactants Ltd. Thank you, and over to you, sir.
Thank you. A very good afternoon, ladies and gentlemen. It gives me immense pleasure to welcome you all for our final quarterly earnings call for the financial year 22. Nicholas Taleb, in his famous quote, summarizes in one statement what happened in the year 21-22. He says, fragility is the quality of things that are vulnerable to volatility. Taking from this, if we were to summarize 2021-22 in one statement, we would say it was the year which separated the best from the rest, differentiated fragile from robust, and tested the vulnerabilities of every business model. While the year began on an optimistic note, supply-led volatility on account of feedstock shortages, shipment delays, rising freight costs, and feedstocks adversely impacted our performance in the first 9 months of this financial year. Though the situation exacerbated on account of Russia-Ukraine war and the Chinese lockdowns, our Q4 performance clearly reflects the robustness of our business model. But we need to understand the crux of this U-shaped recovery. There were multiple factors responsible for the same. One, application of our learnings and experience gained during Q1 to Q3 helped us manage the situation better despite the supply situation deteriorating further in Q4. Better mix and higher share of specialities in the developed markets played a key role in notching up our highest quarterly EBITDA per metric ton of rupees 25,400. Contract divisions and recoveries ensured better realizations. Disruptions in the inflationary scenario too created opportunities which we could capitalize in this quarter. While the EBITDA per metric ton and profitability improved remarkably quarter on quarter, the volume decline is something to be noted and cautiously managed. Ladies and gentlemen, the global scenario remains delicately balanced. Global inflation has not only started impacting people, but now has also started engulfing countries. The crisis in Sri Lanka, Turkey, devaluation in Egypt, and cutback in demand, especially for our performance surfactants, due to overall reduction in consumption and grammage cutbacks, are risks that will have our attention. The home and personal care market grew in the -1% to 1% band globally, with most of our customers registering a decline or flat volume growth. Though the situation remains muted, we are optimistic that the situation will reverse in the coming quarters. A volatile supply side combined with cutback in demand due to downtrading will be the potential downside to our business model in the coming year. FY23, we believe, will be all about effective risk management and capitalizing on every metric ton of volumes to ensure sustainable growth. Coming to the regional performance and outlook, The inflationary scenario has impacted consumption in Turkey and Egypt. These markets make up 50 to 55% of our AMET business. The entire decline in our core Q4 volumes was due to the decline in our performance surfactants business in these markets. The situation remains muted in the short term, and while we are geared up to address the same, we remain cautious. India, while has registered 9.4% volumes growth for FY22, the trajectory of growth has been scaling down every quarter. We are seeing the first signs of demand cutback in India. While the situation is not as serious as the Africa, Middle East, we need to be extremely vigilant and geared up. While the scenario appears concerning in the short term for our performance surfactants, our specialty portfolio is finally got its mojo back. The opening up of developed markets along with operationalization of our new specialty capexes have started yielding results. We see this trend continuing in the coming quarters, which will ensure that we meet our stated EBITDA per metric ton guidance of 16 to 18,000 per metric ton, with a higher probability of us remaining in the upper band. While FY23 will see Galaxy facing both supply as well as demand-driven volatility, let me assure you we are geared up for the same. The strong performance registered in Q4 is a clear reflection of our preparation and resolve. Before I conclude, I want to highlight some of the important developments which have happened in Galaxy. On sustainability, I'm extremely delighted to share with you all about the accomplishment of our goal of becoming a 1.4x water positive company, which is a rare achievement by a chemical company. We are very, very proud of this accomplishment. The outcome we see today is a result of our sustained efforts laid down by our sustainability and corporate social responsibility team throughout the entire journey, which began more than a decade ago. On capexes, some of our capexes got operationalized in Q4, and the complete operationalization of the same will happen by Q1 FY23. These expansions will usher in more opportunities for our specialty care products. Ladies and gentlemen, to conclude, growth is never linear. There will always be short-term hurdles and bumps as we march ahead. While there might be short-term challenges, the long-term structural story continues to remain robust. As John Allen Paulos, a famous professor, said, uncertainty is the only certainty there is, and knowing how to live with insecurity is the only security. Amidst these uncertain times, we continue to focus on our internal stability and march ahead steadily and with firm resolve. Thank you, ladies and gentlemen.
Sir, should we open up for questions?
Yeah, please.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Good afternoon, everyone.
Yeah, good afternoon.
So first of all, congratulations on exceptional performance. And Shekhar sir opening remark, which gives a lot of confidence on how the FY23 is going to pan out. Few questions from my side. First, on the gross profit per kg, 60 rupees from 44 rupees from Q3. Can you help us bridge this expansion? Even rough guess will do on what is the pricing realignment benefit, what is the mix improvement benefit, what is the gain on some inventory and any other factor which has helped, because this expansion in a quarter looked quite sharp for us, and how much of it should be a sustainable number?
Yes, Sanjesh. Natarajan.
Yes, sir. Good afternoon.
Hi, good afternoon. So if you look at the margin expansion that happened, okay, we have said there have been three factors. So what I'd like to say, the inventory gains and the recoveries that we have started getting into the new contracts, okay, certainly and the mix improvement that happened in terms of our specialty ingredients getting better in the last quarter were the major reasons for this. Now, for this gross margins to go up to 60 rupees per kg. It is also important to note that our US subsidiary Trike has been doing exceptionally well, given that the US market has been pretty robust, and they have been able to get their realizations and their volumes in a much significantly better manner. In fact, Q4 was a very big highlight for them in terms of their performance. And what has aided that also was the expansion we commissioned in our US facility just before COVID hit us, and that stood us in good stead in terms of this particular expansion in gross margins that you're seeing.
How much will be protein nitrogen now for us?
See, in terms of volume, it is not anything significant if you look at overall volumes, but in terms of the realizations are pretty significant, okay, and they have been doing pretty well. A lot of work has been done over the last 2 years in terms of expanding our proteins portfolio, and in terms of the sort of range we have on the various vegetable proteins, and the way we could capitalize on the opportunities that got presented itself, okay, during the last 18 months. And we continue to see that going to be in the same trajectory in the coming months.
Is it fair to assume that our US has grown in FY22 upwards of 40-50%?
Yes, sir. In terms of their performance, yes, they have.
They have grown. Okay. Yeah. And you think that can continue for a few more years to come, right, on a low base?
Yeah, we do see that continuing, okay, except that I would like to have a word of caution because we are also seeing that the inflationary pressures are impacting US as well. So how that market pans out, how the consumer demand will get impacted, because inflation is a question that none of us are able to answer now. But if I see as of today, I expect these things to continue without everything else remaining same. I don't see why this can't continue.
No, I was more thinking in a way that this is more of a luxury product where inflation doesn't really impact so much, right? Inflation is more on the mass and the masstige product. On the luxury, we are generally protected out of inflation.
So what I was trying to explain was, these are specialty, highly special cosmetic proteins. So what can happen is that if the demand, if the inflation situation continues very high, you can have consumers, okay, starting to downtrade. Okay, so that can be a risk there. Although that's something that may not happen quite suddenly.
It's a luxury item, generally doesn't happen that way.
Yeah. So we hope that. That's why I'm saying that as of now, the way I see it, we don't see this not continuing. There's no reason for that.
Okay. On the MAT side, this is the fifth quarter of a volume decline, and we have declined crop sharply, 29%. On a base where we have declined already 5%. Right? Looks like a complete collapse in MAT. And last few quarters, I could have understood that we were fighting with ethoxylate availability and so on and so forth. Even on a low base, a 29% decline, was it difficult to place the volumes from the Egypt and Turkey to the other market? Was it a difficult situation, or it happened and you were also not prepared for it, and hence we should be able to adjust this volume in the coming quarter? How should we see this?
So there are two things. One is, if you see almost the first 6 to 8 months of the financial year, there were severe supply side constraints because of the global international logistics scenario. Now, obviously, it also meant, okay, that there are some customers, obviously they would have met the requirements elsewhere, people who could give them the material. So as our team looked at keeping all our key customers in place in terms of servicing the volumes, and as we were doing that and the supply situation are improving, you had this huge impact in terms of inflation and the Egypt and Turkish devaluation, which started impacting demand. So it's something that we are working on, and we do see things improving, but a demand cutback has happened because the inflation scenario is something that we need to factor in right now. It's not that we were not seeing this trend coming down in terms of volume, but to this extent we didn't expect.
Okay. So we could now take some course correction from developing few other market and all. And what was the learning from ourselves? Because this happened in Turkey in 2019 also, right? where we saw 2 quarters of sharp decline and then we smartly bounced back.
Correct.
What was the learning from that time, and do you think this time also that's fairly possible?
See, last time what happened was, if you look at the learning, the consumer demand didn't get impacted that significantly. So there was a situation where people were adjusting to it, and they adjusted to it quickly. Now what we need to be waiting for is whether the situation, the consumers adjust to this sort of inflation quickly. Because it's all about consumers adjusting to the changed dynamics, correct?
Mm-hmm.
That happened last year, but we are always well prepared in terms of leveraging on the opportunities that present once the consumer starts adjusting to the inflationary scenario. And we would expect the same thing would happen now. Only thing, we are not able to make a precise guess on what the timing would be, whether it will be 6 months like last time, or it can be beyond that, or even lesser than that.
Okay. But do you think there is a scenario where inventory liquidation has also happened, which will correct, right? Sometimes when in high inflation, people tend to liquidate the inventory.
Yes, that's possible. So it's quite possible that, and obviously with people wanting to carry on their price increases, they would want to flush out the lower price inventory from the system. So this is something that can be a good tailwind, but we only hope that this is the way it pans out in the coming months.
Got it. Just one last from my side. On the rest of the world, the bounce back looked quite interesting. It is because we were constrained by capacity and new product addition have done very well. And which are the segments which are performing so well? Is it more of a preservative and mild surfactant at pulling us, and that is why the realization have so much of a large benefit because these are high margin products, right?
All the specialities, Sanjesh, all the specialities. We would certainly say yes, there was a constraint on capacity before, which we do not have it now. One, because they were waiting for the operationalization of the new capexes. And number two, of course, we have repeatedly said that we were also constrained by the outbound logistics, which certainly improved in last quarter, but we are afraid, I think it is again reverting back to square one with whatever is happening in China now. So so these are situations which is what we say highly volatile, and we need to be very careful in navigating these waters.
Just one bookkeeping. Which are the products which we have commissioned now, and what are the capacity addition?
Well, we say that we had commission capacities on mild surfactants, non-toxic preservatives. So these are the, and we also commissioned our proteins plant in a new plant in Delhi just before COVID hit us. Right? That was in 2020.
And what was the capacity we added there?
So these capacities, we would not want to be mentioning that because it's something that we would want to keep it confidential. Because these are specialty ingredients, and we're not. But in order of magnitude, because they can be in the zone of about 10,000 tons an hour.
Oh, such a large! I think we had only 1,000 odd tons earlier, right?
Which one?
In Trike, the protein capacity was some 600 odd capacity.
Everything that we did, all put together, including all my mild surfactants,
okay, all the three,
and other specialty care ingredients.
Okay. This is not particularly for US. It's India plus US.
No.
Okay. That's fair enough. Thank you, sir, and best of luck for coming quarters.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question may please press star and 1. The next question is from the line of Rohan Gupta from Edelweiss. Please go ahead.
Yeah, hi, sir. Good afternoon, and thanks for the opportunity. Shekhar, sir, thank you very much for sharing all those insightful wisdom quotes in your opening remark. That's great.
It's all credit goes to our team.
No, sir, definitely. They have done a remarkable job in linking all those quotes with our current performance of the company. A few questions from my side. The first is on this EBITDA per ton or gross margin per ton. Definitely, sir, I mean, it's a unheard journey. I mean, improvement in such a small period of time from EBITDA of almost 12,000-13,000 rupees, couple of quarters back to 25,000 rupees, driven by gross margin. Sir, we have seen that how the Galaxy's journey has been from almost 12,000 rupees average margins to 15 to 18, sustaining there, and now we have seen this unheard 25,000 rupees per ton. Though in the challenges of the business and volatility which any business have, do you see this FY23 is going to sustain on an average these kind of margins, or probably the change in the product mix will pull it down? That's the first question, though.
Yeah. So what I would respond, Rohan, is that we improved our guidance from 15 to 17,000 rupees per metric ton to 16 to 18,000 ton. And then if you see now, we had told in the last investor call that we would come back. We were lower than 16,000 tons, okay, 16,000 rupees per metric ton for the 9 months, and we said we'll get back to the 16 to 18,000 tons at the full year level, which has happened because of what we did in Q4. Now, moving forward, what we would like to make it clear is that we will continue with this guidance of 16,000 to 18,000 rupees per metric ton. And yes, to be a little bit more positive, we do see it can be at the upper end of the band of 16 to 18,000.
Sir, any particular reason that we still will not change the guidance to slightly on a maybe 20,000?
It happens. See, we know that the trajectory is towards the upward trend. Okay, but nothing will happen overnight. They will be gradual. Okay, they will be progressive, because as we have said, for us, both the pillars, both performance surfactants as well as specialty ingredients, are key in terms of sustainability of our business model. Okay. Both are equally important as far as this market is concerned, the customers are concerned. Okay. So we will, our strategy, as we have mentioned, is to grow on both these legs, that is performance surfactants as well as specialty ingredients.
Right, sir. So in the current quarter, it was more driven by the higher share.
Yeah, in the current quarter, as you would have seen, we did talk about challenges to our performance surfactant business. Obviously, the specialties performed much better. They constituted more of the total portfolio of our products, and they resulted in this particular EBITDA margins. It tells you about the potential from specialties.
Exactly, and it also tells that how high margins are in our specialty products. So,
I'd like to clarify, Rohan, as I explained when Sanjesh asked the question. There were three factors. One is in terms of the raw material price increases that are happening, say, almost up to November, almost every 15 days, where the intensity and the frequency was high. So as we were passing on one increase, another increase was happening on raw materials. Now that actually started stabilized at those higher levels, say from December onwards. Okay, so that enabled us to, otherwise there's always a lag in terms of passing on. So that obviously didn't happen. The lag wasn't there because the increase had stabilized, the prices had stabilized at the higher levels. Second is we also said that we had a lot of logistics related costs that were higher in terms of shipping costs going up, which also start tapering off in terms of increase, and then we didn't have any backlog in terms of recoveries. The third is we talked about the certain recoveries in when we did certain contracts that were there in place and we renegotiated the contracts. We were able to, with the sort of equations we and relations we have with customers, we were able to get some of them added to our pricing in the new contracts. And the fourth obviously is also the mix that improved. So there were four factors that led to this.
Okay. Sir, second question is on a tepid volume growth for the quarter, especially in surfactants. So, is there any particular one reason that this volumes was impacted, or do you see that?
Inflation across the world, unprecedented inflation. Okay.
So this 15%.
The inflation has certainly impacted consumption, and as we said, inflation has impacted even countries.
See, I tell you, I can explain this. When there is such a unprecedented inflation, the issue is in terms of people wanting to wait. So what people would say is that, say, my customers who essentially have to make the finished product, okay, especially my tier 2 and tier 3 customers, they would say, let me watch as whether the increase is going to get absorbed by the consumers when they increase the price. So there will be this situation where they will say that they will reduce their pipeline inventory, They will wait for the consumers to digest that particular enhanced prices. Okay, and they would want to test that out because they would not be buying in a normal way that they buy if the things were stable, correct? So that's also one of the reasons.
Absolutely agree, sir, and that's what the uniqueness of our business is that we are catering to, we are proxy FMCG, where people would not stop taking bath and will not stop taking washing their hands. But I understand that the weakness may be more to do with the vacuum in the channel filling or the in the trade. That should pick up, or that may pick up going forward, because ultimate consumption is not getting hit, or you see that there is a ultimate consumer level, the demand is getting impacted, and if the inflation and the prices remain at the current level, we may see that the lower demand from the FMCG.
Yeah, so if I were to explain to you, say for example, this is what I'm saying. I'm saying that the way demand cutback would happen is that one is people will downtrade. Downtrading doesn't impact us because we serve customers across all segments. Okay, be it tier 1, tier 2, or tier 3, and we have product portfolio to cater to all these segments. But what we have to note is that, for example, in rural India, if people in the last 2 years, the rural population started using, say, a shampoo, okay, from what they were using once a week to 3 times a week in terms of habit change. Now, what if they say because of the disposable income getting reduced, they probably will come back to say twice a week. Okay, so that obviously can have a demand cutback, correct? That is something is what we need to wait and watch as to how things are panning out. If the harvest is good and there's a good liquidity in the hands of the rural population, we do see that the demand is not going to be significantly impacted. So we need to see the ability to observe as the various moving parts, okay, and these things all have to play out very well, and that's why I say that next 3 to 4 months will tell us the story as to how things will look going forward.
Okay, so can you provide us a regional market share for the quarter and versus last year?
Regional market share, I didn't get your question, Rohan. Means how the market shares moved between in the various regions.
Sir, we have got, you share the volume growth.
Yeah, so if you ask me, our business is split almost one-third across India, Africa, Middle East.
I think last year it was approximately India and AMET put together was approximately 75 to 76, and the rest of the world was, again we say FY22 was 37, 31 and 32. Okay? That is 37 was India, 31 was AMET, and rest of the world was 32.
And what it will be this year?
This year, see, we don't expect these ratios to significantly alter, but AMET is something that can be a little muted. Again, for quarter 4, India was a little down compared to the last quarter of last year.
Fine, yes, sir. Sir, as far as our spec chem business is concerned, so we have done a significant capex in last year, completed now. We see that this year was a ramp-up year for the specialty chemical business. What kind of growth one can expect in FY23 from our specialty chemical business, because given that we don't have any capacity constraint now?
See, normally as we say, when we build a capex, it is for a horizon in specialties for something like 8 years, 7 to 8 years or so. So there will be progressive growth as far as these products are concerned. Okay, so we have seen the first leg of growth in last year, and these will continue. This momentum will continue.
And so just lastly, the capex number for FY23?
Yeah, FY23 will be again approximately 150 crores. 150 to 200 crores. Last year we spent 155. We spent 155. So again, the coming year, that is FY23 will be 150 to 200 crores.
Fine enough, sir. Thank you very much. I'll come back into you for any further follow-up.
Thank you.
Thank you.
Thank you. The next question is from the line of Anubhav Sahu from MC Research. Please go ahead.
Hello.
Yeah.
Hello. Hi, sir. Thanks for the opportunity. A couple of questions. One is, in previous quarters, you have also mentioned that, volumes getting impacted because of supply issues in terms of timely availability of raw material and things like that. How's the situation on that front? Are we still getting impacted on that front?
The situation did improve in quarter 4, okay, but because of this Russia-Ukraine issue, and also because of this very, very stringent Chinese lockdown in China, is certainly again presenting new challenges. And we are already seeing that. So we do hope that it will take another about 2 months with something new not happening for things to resolve itself. So we were pretty happy in the beginning of Q4 that things are getting resolved. But these two events, okay, have again started complicating the international logistics scenario and thereby also creating issues on the supply side.
Okay. And by any way, can you quantify this impact? I mean, in terms of volume, which would have been possible, but it's not happening because of the supply issue?
No, there is nothing. I don't think we'll be able to quantify that. It's only that we did say that there was a good amount of impact up to first 9 months. Q4, I would not say there was anything significant because things improved. But moving forward, we will not be able to quantify. We only are hoping that we are able to manage it without a significant impact.
Got it. And secondly, you have alluded to domestic situation that there is a probability of demand cutback and inflation impacting consumption. But on the other hand, the other narrative was, of course, that with the opening up of economy, demand should actually firm up as far as the out-of-home applications are concerned. So wanting to understand, right now, is it more a channel inventory correction, which is that what you're seeing, right?
Yeah, Anubhav, let me say that the long-term outlook is excellent as far as this industry is concerned. Okay? Whatever we will see now, they're all short-term challenges. Okay? So as Rohan said, people cannot stop, taking bath or brushing their teeth or washing their hands. Okay? So whatever we see, they will be short-term blips.
Okay. Got it. And do you have a view on what is the market share we have in domestic market?
We have a significant market share. We will not talk about the number. As we have always said that we have a significant market share, and we have had over the last now 42 years.
Okay. And so last question on this fatty alcohol prices. How are you reading situation now? And I know there's a supply setback because of palm oil, but how much that is impacting palm oil derivatives for us in terms of availability as well as pricing?
First correction, the market is so volatile that we are not reading, we are only watching. Okay, so if you see, it went up significantly, okay, in because of that Indonesia stuff, and then it started correcting downwards. Okay, then again it went up because of the ban that Indonesia put. But we do see that this particular, there are high season months approaching now, so we do see that things should start stabilizing. But we wouldn't know. We can't make any clear judgment on that because there are too many things that are happening at the same time. So as of today, the prices of fatty alcohol are close to $2,800 per metric ton. Okay, we do hope that with the high season months coming in and the inventory level going up, things can start coming down. But we need to wait and watch.
Okay. So on a longer term, I mean, how you seeing the palm oil? I mean, of course, there are a lot of supply side issues as far as the palm oil is concerned. Labor shortage is also one of the reasons post in the COVID era. Is there also a structural reason that the palm oil getting diverted to biofuel and all those kind of things? So there would be new normal.
Yeah, Anubhav, see, if you see the last 15 years, this volatility has been a part of this commodity industry, and particularly with respect to palm and palm kernel oil. Okay.
Right.
So as we said, the bottom line for us is that the way to grow our business is to have effective risk management with respect to our feedstocks, and that's what Galaxy has been doing over the last 10 years. We have gained our skills with respect to effective risk management on this, and we don't believe in predicting what will happen, whether the feedstock prices will go up or go down. For us, the constant is how we manage this risk.
Biodiesel mandate is only for palm oil. Palm kernel oil, which is the major, palm kernel oil derivative is what we use. So the biodiesel mandates are for palm oil. Okay, I'd like to correct that.
Yeah.
Okay.
And palm derivatives are not the major raw materials for us. For us, the major derivatives, which is fatty alcohol, is from palm kernel oil and not palm oil. Okay.
Okay. Yeah. Okay. And so you mentioned about risk management part. So how is the contract cycle happening on that side as far as procuring L'Oreal alcohol is concerned? I mean, is it?
I cannot say how we manage it, because that's something that's proprietary to us. But it is suffice to say that it is ensuring that we do not have any open positions which are something that we can't digest in case a big correction happens. That's the way risk is managed.
Okay, got it. Yeah, no, that's helpful. Yeah. Thanks a lot, sir.
Yeah.
Thank you. The next question is on the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, thank you for taking my question, sir, and congratulations for a good set of numbers. So some of my questions are already answered, just a few from my side. So one, obviously, we know that there would be some contract revision in this Jan period, commissioning of this new year. So how much out of how much total contract has been revised, and is there any still left few contracts to be realigned with the current existing price, or we should be having all those contracts has been already realigned to the current market price?
No, see, there's nothing like, our contract happen only in the beginning of the calendar year. So there are contracts starting and ending at various periods during the year. So it's not that, the contracts that start getting renewed only at the beginning of January. So there are a lot of contracts that keep happening at various times of the year, depending on, the products, okay, and the customers. So it is, what you need to know is that we are ensuring that every contracts are properly renegotiated to take care of the current scenario.
And what we are normally seeing also in the current scenario is that the long-term contracts, which were earlier, you can say more than 1 year contract. So a lot of contracts are now shifting from annual to maybe quarterly, or maybe half year. Quarterly or half yearly kind of changes there. So is that happening for us also, or is it that all our contracts are still in place with the long-term perspective?
Yes, there's nothing major change that is happening in terms of the contract tenures. Okay, so things are in line with what we used to be doing earlier.
Okay. And sir, in terms of the volume growth, just wanted to understand, since we have, I think I would say, a decent size of customer base. So the incremental volume growth which we will be seeing would be coming from penetrating these customers, or we have still sort of scope of adding new customers?
No, we have a huge scope of adding new customers, which we are constantly doing. So our whole this thing is based on how do we penetrate various countries that we are currently not present. Okay, how do we gain share from existing customers, and how do we hunt for new customers? So, and there is a huge opportunity for us to mine newer and new customers in various geographies.
Okay. So any ballpark number we can put on the volume outlook for maybe 23, 24?
No, we would not. That's why I said, so I don't want to hazard any guess, because things are pretty nebulous. So with various events happening, so we need to wait for, I think, at least 2-3 months to understand, okay, as to how things are panning out.
Okay. And one last question, especially from the Turkey side. where I think currency depreciation is significant there. So how we are seeing, I mean, the scenario currently, and is there any, I mean, any takeaway we can have from the current development there, or majorly if they in terms of our exposure in those regions?
So what I explained to Sanjay, so typically we have to wait for the consumers there to be able to adjust, okay, to the higher price scenario. And yes, and as our products are into daily use items, once consumers adjust, okay, then the demand should start coming back. So as Sanjay said earlier, when the similar thing happened of Turkish lira depreciation, things started improving after 6 months. So we do hope that, it happens earlier than that.
Okay. That's it from my side, sir. Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Rohit Nagaraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity and congrats on a very good Q4. So first question again on the volumes front. I understand since our IPO we had been saying that our volume growth will be in the range of 6 to 8%. Last two years have been quite challenging. FY23 also, you just suggested that would be a challenging and we are not having any clarity. But instead of having this volume growth, which will probably be skewed towards specialty care products where the volumes will be lesser for the incremental quantities like mild surfactants, etc. However, the pricing and EBITDA would be far better than the existing profile. Do we like to give a guidance on absolute EBITDA increase? Because I think earlier we used to say that 6 to 8% volume growth and absolute EBITDA increase would be in, say, teens or double digits. So would you like to give any such guidance for FY23, 24 or incrementally? Thank you.
Yes, so on EBITDA, we said that the guidance will be in the range of 16 to 18,000 rupees per metric ton. And we said if you look at a positive side, we probably will be at the upper end of the band.
I'm talking about absolute EBITDA in terms of not EBITDA per ton.
Absolute EBITDA, I don't think we'll be able to give that guidance.
Fair enough, sir. No worries. So the second question is in terms of our product basket or diversification. So earlier we had gone into adjacencies like Tricare acquisition where it is into proteins and high-end maybe products. So any such adjacencies are there for us to venture into? That is A. And are we looking very concretely in terms of getting into such adjacencies, given that the current environment, the existing business is going through a rough patch and these adjacencies probably would be beneficial from a revenue profitability perspective? And second, these could be also a growth driver going forward. Thank you.
Yeah, so we have always been catering to adjacencies. While we say our focus is on catering to the home and personal care market, okay, which is our focused market, where we essentially are solution providers. For adjacencies, we obviously sell the molecules. Okay, we do supply into agro, we do supply into pharma, okay, we do supply into textile. We do that, and that is something that we are ensuring that we are able to capitalize on all the opportunities available. But we cannot shift our focus saying that since HPC is not growing, I will shift to the other industries. That is something will be fraught with a huge amount of risk, which we'll never do. Because HPC industry is the best industry to be in terms of the way that we have built our capabilities. So these are all, as Shekhar said, these are all short-term blips. The long-term structure of this business and this industry is extremely exciting.
Right, got it. So just one clarification on this front. This particular confidence which we have in terms of the long-term prospect, does it come from a sense that other global players are not really keen on expanding their business, or is there any other element into it? Thank you.
We don't know anything about those things. Okay, we focus on ourselves.
So the confidence, only way to explain is the confidence is in terms of emerging from the way we know this industry and our 40 years of being in this industry.
Right, sir. Got it. Thank you so much for all the answers and best of luck, sir.
Thank you. The next question is on the line of Sudhanshu from Merculus Investment Managers. Please go ahead.
Hello, sir. My question is on the working capital of the company. So we see a lot of deterioration in the operating cash flows of the company, primarily because the money is being invested in inventories and receivables. Can you give us some clarity on where does the company stand? Has the terms of trade changed where we have structurally changed our inventory days or inventory levels and debtor payment terms? Or is it just a transitionary phase which we are witnessing right now?
Yeah, see, in case of working capital, it is essentially a function of what the dynamics of the market is today, right? Okay. Now, one, in terms of earlier also we have said higher price values will result in higher monetary working capital. I think during the discussions we have said that, right? Okay. It's a feature.
Yeah.
So the price levels are impacted. That is one. The second is the transit times. And the third is essentially raw material uncertainties have resulted in procurement of raw material from those sources which are not regular, resulting in advance pay. These are temporary factors, and once they cease to exist, this liquidity will get released.
Okay. So would it be fair to say that there has been no change in the credit terms offered to our customers and no changes in terms of the inventory?
Yeah, clear.
Yeah, credit terms have not changed.
All right, sir. Thank you very much.
Thank you. The next question is on the line of Abhijit Sinha from Pi Square Investments. Please go ahead.
Good afternoon, sir. Wanted to understand the debt. We've increased the debt this year, so where has that been allocated for? And the CapEx that you mentioned about 150 to 200 crores next year, where will we be using that? And the 150 crores that we used last year, where did we use that?
Can you, I think we weren't able to hear you clearly. Can you?
Am I audible?
Yeah, can you repeat your question? We weren't able to hear clearly.
So I'll go step by step. Firstly, the debt that we have has increased a bit, right?
Wait, what you say? The debt has increased?
The short-term debt, sir, if you see, it's now about 290 crores. Right.
Yes, that is on account of two things. The cash generation has gone into the working capital, which has been expressed, right? Okay, but the debt equity ratio has not changed.
That has not changed. That has not changed for sure. So that is just for working capital requirement?
Part 2 too. Okay.
Sorry, sir, your voice is not that audible.
One minute.
See, what we mentioned earlier in the last question is that the entire cash generation that has happened during the year has got basically sucked into the working capital, all right? And that has happened on account of higher raw material prices. So what is going to happen is that to the extent of our other funding needs in capex, there has been a borrowing, right, up to 90 crores or so extra. But in terms of debt equity, if you look at it, it remains 0.22 only. It has not increased.
True. And sir, the 150 crores that we used last year was used for which plant exactly?
It was used for the various specialty products, as well as certain performance products, both in Egypt as well as India. And India, largely, we said we incurred it on our Jagadia project for manufacture of mine surfactants and non-toxic preservatives, and also our R&D center in our pilot plant center in Tarapur, where we spent this. So as we also said, some of these have got operationalized, and some of these will get operationalized by the end of this Q1.
And we have mentioned that our cash outflow on account of capex is 155 crores.
Yeah, we have also mentioned that our capex of last year was 155 crores.
Yes, sir, I totally understood that. So just for my understanding, the capacity as per se has not increased. It's just for, the supplementary stuff such as R&D centers and everything, which will help eventually for the company, right?
No, certain capacity increases also have happened. we did mention right in the beginning, we have increased capacities on mild surfactants, non-toxic preservatives, and also our investment in the pilot plant and R&D center, which will really drive our innovation over the next coming years.
Exactly. And so the next 150 crores that we're planning for this year, that will be used in the similar region? Like where will we be spending over there?
It will again be for similar reasons.
Same R&D stuff and all. Perfect.
Like R&D plus mild surfactants plus non-toxic preservatives.
Got it, sir. Last question would be, sir, that I think you mentioned it earlier, but since obviously Egypt and the AMET region is facing quite a bit of a problem for us right now, since the economy is not that great, what is our timeline as a business? When do we see things stabilizing there? And if it still impacts our this year, FY23, what kind of impact do we see?
See, if you remember correctly, Egypt, we have seen impacts in 2016, 17. Then, but Egypt as a country, the population is suddenly growing. Okay, so it will pass through these challenges and ups and downs. But then eventually it will come back to its consumption. It has to.
So what kind of timeline do we think that it should come in? Like 9 months?
There is no point in me thinking. We can only say based on our past experience. When earlier this happened in terms of when the depreciation of the currency happened, it took almost 6 to 9 months for things to come back for the consumers to adjust to the inflationary scenario. Okay, so we do hope that it can happen earlier than that. Okay, now, but we will not be able.
The situation in Turkey is even worse.
Huh?
Because the situation in Turkey is even worse than Egypt, right?
Yeah, I wouldn't be able to make that statement because consumers should know how to adjust. Governments also have to be equally concerned about ensuring that the consumption picks up, correct? So the government can come up with some stimulus. We never know. Because as much as we are bothered, the governments are more bothered in terms of ensuring that the people are able to manage in the inflationary scenario. So we need to wait and watch. So we can only go based on what the past experience was. We don't have a crystal ball in terms of saying as to when things should improve. We only want to hope that it improves much earlier than what happened last.
Fair enough, sir. So you mentioned that you specified that our raw material is not the crude palm oil thing, it's the palm oil kernel, right? So what would be the pricing or the demand supply differences between the two?
Demand supply situation
of
the kernel. You mentioned that is our actual raw material, not palm oil itself.
Correct. So the palm kernel oil also has seen significant volatility. Okay. So as Natarajan mentioned, the ups and downs in laurel alcohol that we saw was in sympathy with the price of palm kernel oil going up and down. So in this year, in the last year, I think we have seen the swing of laurel alcohol prices right from 2,100 to 3,200, coming back to 2,450, again going back to 2,800. So these swings have been happening over the last 1 year. And we see this happening even in the coming year.
Okay. So, sir, 16% EBITDA margins are not that likely for FY23, but can we expect about a 12 to 13 rather than a 10%?
No, we would not say, we would not make any say. For us, EBITDA percentages don't make any relevance.
EBITDA per ton, we have talked about the guidance between 16 to 18,000, and we are pretty optimistic and hopeful that we will remain on the upper band of this range in the coming year.
I hope so too. Sir, thank you so much.
Yeah.
Good luck.
Thank you. The next question is on the line of Bob from Falcon Investments. Please go ahead.
Yeah, hello. Regarding the performance surfactants, how's the demand now versus the COVID times? Has it gone back all the way to 2019?
See, the demand certainly, as we said, there has been a cutback. Your inflation has certainly had an impact on consumption. Okay, our customers, and that is the FMCG manufacturers or the home and personal care manufacturers, have resorted to maintain their magic price points by reducing grammages. Okay. And that is how they are trying to serve the customers so that they are able to retain the customers, albeit with the volumes getting impacted at their end. So this is going to be certainly an issue and a situation while the commodity prices remain very high. Once the commodity prices start correcting, I think we should see, we should come back to normal in terms of the volume growth that we see as far as this industry is concerned. We have seen that for ourselves, this industry has grown globally at a level of 2 to 3%, and the Indian market has grown at a level of something like 8 to 10%. Over a long time span. So we see this coming back once these commodity prices start correcting.
Right. When you say coming back, you mean the old demand or the post-COVID demand? Because there was talk that some of the hygiene practices would sustain post-COVID.
The COVID demand which happened on hand sanitization and hand wash corrected last year itself. Okay. But then the habit of washing their hands is something which will be sustainable. So we saw the hand wash markets, which were growing in the COVID times by about 30%, got corrected to coming back in terms of growth rate of about 10 to 15% or so in the last year.
But still higher than normal times.
Yeah, they are higher. So to answer your question, the overall entire HPC category obviously is settled at a higher level than the pre-COVID volumes. Okay, very clearly. Only the rate of growth is getting corrected, but yes, it is higher than the pre-COVID volumes.
Okay, second question on down trading. You had mentioned earlier that would actually cause, it'll have an effect on your sales, but you do supply to a range of manufacturers. So do the tier 2 and tier 3 have lower pricing for your chemicals versus the top tier?
No, it's not. It's what they buy. So essentially the formulations are different. For products that are, say at the mass segment, the products are different, so they require different ingredients. Okay, that because the ingredients are having a different specification and performance, okay, they will be a lower price. So it is not that for the same product we have lower prices for tier 2 and tier 3 customers. Yeah. No.
I understand. So in that sense, down trading would affect your business.
See, what we are seeing, what our salespeople, tell us is that the small customers' problem is now cash, because the prices have risen significantly. They would have to work or manage their operations with a lower level of inventory. Okay, they can't afford to have or maintain more inventory, so they would possibly live for the day, in a way of saying that they live for say 7 days in a series. Okay.
Right. Okay. Understood. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Unnatan Shekhar for his closing comments.
Thank you very much, ladies and gentlemen. See you again in another 90 to 100 days. Thank you.
Thank you, all of you. Thank you so much. Bye-bye.
Thank you, ladies and gentlemen. On behalf of Galaxy Surfactants Ltd, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.